But we got to start this morning, Saz, with that economic data. Really interesting stuff here. And again, the PCE is important, but the employment cost index getting a lot of attention because there's so much focus right now on wage growth and what that is going to mean for overall inflation. So the ECI coming in at a 1% increase in the fourth quarter. The estimate was for 1.2%. So that seemingly being seen by investors and economists as perhaps a little bit of good news. The prior read, by the way, was 1.3%. So a slowdown in those gains. And then let's talk about that PCE, the deflator, the core deflator coming in at 4.9% year over year. That is a little bit hotter than estimated month over month, 0.5% gain. Why do we talk about this one so much? It's the one that the Federal Reserve has told us they are watching most closely. A couple of other numbers to highlight, and one of them is disappointing, and it's personal spending. It was down 0.6% in the month. That is from a revised 0.4% gain the prior month. So it was a downward revision the prior month. It's bang in line with estimates, but still continues to be interesting here that we see rising wages and not necessarily rising spending. So personal incomes, by the way, up 0.3%. So I think I ran through all of it there. Saz, what stands out to you in terms of what we need? I mean, that's a lot to digest, obviously.
You did good.
I see the gears moving. I see the gears moving right now.
Yeah, the smoke is probably coming out of my ears. Correct. Look, every time I read this report and we get this report, I always think of the person on the other side of the screen or who is on our platform right now. These are a lot of confusing numbers, a lot of things that are great for economist models. And I think a lot of people wonder, what does a report like this mean to my money? So I'm going to tell them right now, if you dig down deeper into this report, you see private sector wages, salaries up 5%, benefits up 2.9%. So that brings the total benefits cost higher by 4.4% year over year. Bottom line, this report is yet another inflationary read that only will fuel, I think, the narrative on the stream. We'll talk about this Bank of America note we just got here calling for more rate hikes, but still just as feeds the narrative that we've been seeing in the markets this week. Higher inflation, here comes the interest rate hikes, and those high momentum, those highly valued tech stocks or other names like it, those momentum names may still have a tough time here in the near term.
I think that's all fair to say. I would also say that this report, though, is not hotter than expected. So those who think the Fed is sort of behind the ball here, this doesn't alarm them, so to speak, right? Because some of these numbers not looking as hot as expected. Let's talk about that Bank of America report for a moment, shall we? Because the report that you're referring to comes to us from Ethan Harris, the global economist over at Bank of America Securities. And in it, he is calling for potential 7 increases this year from the Federal Reserve, 25 basis points each. And he says a peak funds rate of 2.75 to 3%. He says this should affect the economy with a lag weighing on 2023 growth. And that's really the fear here by some in the markets, is that as the Fed is increasing rates, it's going to choke off growth in the economy. Now, growth right now, the bulls will tell you, is robust enough to withstand it.
They always tell you
that. I only think I don't think we know at this point what's going to happen.
It's fascinating, Julie, to watch strategists on the street. They are now essentially all tripping over themselves to predict more rate hikes. Yesterday, we saw Deutsche Bank, Matthew Luzetti, one of the top minds on the street when it comes to the Fed. He lifted his rate hike expectations for this year to 5. And now coming into the year, most strategists on the street were looking for about 3 hikes. So the most aggressive call coming into the year, I would argue, was Goldman Sachs. I believe they were at 4 rate hikes. So 7 rate hikes. And also, let's keep in mind, look at what Ethan Harris also did. With those increased expectations for rate hikes, he also cut his GDP estimate for this year. So he's looking for GDP this year to be 3.6% down from a prior estimate of 4% here. To me, that read is higher interest rates, growth is slowing, perhaps justifies all this volatility we're seeing in the markets here.
And I admit, when JP Morgan's Jamie Dimon was asked about rate hikes this year, and he said, yeah, there's going to be 7 or 8 rate hikes, I laughed.
Yep.
I'll admit,
We all did.
I thought that seemed like a wacky prediction. Maybe it's still a wacky prediction. I don't know. I again, as you know, I don't make predictions. I just criticize other people's predictions.
Well, now we know why Jamie Dimon
which is an easy
has been in
place to
this
sit,
role
right?
for like a gazillion years.
Yeah. So in any case, this data that we got today, I don't think in and of itself significantly moves the needle one way or another on what the Fed is going to do. And maybe to some extent that was reassuring in equity markets because we did see futures come back a little bit after this report came out. Maybe that's the most benign reading on this.
I'll just say, let me just add real quickly too. When you see a Bank of America come out with a report like this, this report they get used by the company's trading desk. It gets shared around on Wall Street, and now suddenly, you could see a fresh move or waves in many markets as perhaps traders sell positions on the expectations of 7 rate hikes. That wasn't in anybody's cards coming into this week, I would argue.
Yeah, except Jamie Dimon, I guess. I don't know. All right.